Talk about the global cues this morning, and an encouraging start to earnings season helped US stocks rebound on Wednesday night from 5 days of consecutive losses. However, equities cut gains in late session after US Fed said that rising energy costs were a concern for economic growth. Sectors linked with economic growth led the way higher as their recently beaten down prices made them attractive for investors as well. Alcoa, that shot up a good 6.3% after the Dow component reported a surprise first quarter profit. Dow rose a good 89 points after falling 200 the day before. The S&P 500 index was up 10 and the Nasdaq Composite as well advanced a good 25 points.
But globally, there is a feature of risk-off which is at play. Copper prices have corrected, crude prices have corrected, and one is getting a sense that in the medium term, money managers are now pulling money out of commodities, they are pulling money out of US equities, and they are revisiting US treasuries and dollar. If you check on Asian markets, they are trading mixed. Major Asian markets are in fact nervous because China is due to declare their GDP data, and this time around expectations from the Chinese economy are rather diluted. But what about our markets? Well, on a day when fear trade dominated global markets, bulls were in motion, and Nifty has managed to close above 5,200. So yesterday's close for Indian markets, to my mind, is a real victory for the bulls, and what really got the bull in motion was some degree of short covering in the Bank Nifty and Nifty futures. But even though markets, they recovered from the day's low, foreign institutional investors were not biased. So if you really have to underline a very important feature which has changed for Indian markets is the institutional support. So in the near term, what will impact Indian market is not Infosys, it is not Reserve Bank of credit policy, it is what foreign institutional investors have done of late and what they are now doing. In the month of Jan to March, they were in a buy mode. They pumped in about $8.5 billion, but in the month of April, foreign institutional investors are in a departure mode. Globally also, like I mentioned, global growth scare is back. A risk-off trade is getting played out. So yes, yesterday bulls did manage to defend that mark of 5,200, but that is no measure, Aisha, of what lies ahead. Michael Woolfolk joins us, Managing Director with the BNY Mellon Global Markets, joins us live from New York. Michael, good morning. Thank you for joining us. Michael, last night US markets have managed to snap their 5-day losing rally. Do you think that this is a time when investors should use every strength to their advantage to exit?
I think that we were going to see continued correction from the rally that we saw in the first quarter. April, we've already seen some correction. I think that we see a further correction, and that we are waiting as a market for the general election in Greece coming up in the first week of May. I think that we probably stay cautious. Markets continue to give ground through then.
Michael, hi, morning. What about the U.S. markets, though? While they've snapped their 5-day losing streak, Apple has come to the comfort, as always, when it comes to the Nasdaq move. You've got banks which are holding up very well. It seems like, Fed's neutral stance in the monetary policy is pretty much working for the U.S. equities right now.
Yeah, I think that certainly Bernanke has been happy with the incoming data. Recently, last Friday's disappointment in non-farm payrolls certainly underscores Bernanke's case for the reason to maintain ultra-accommodative monetary policy because we're not out of the woods yet. The economy is still fragile. I think this gives him plenty of ammunition to continue with quantitative easing, a third round, in the United States in coming months.
Michael, what do you make of the Beige Book commentary? The Fed once again has admitted that in the near term commodity prices could challenge the U.S. economic growth.
Yeah, well, our Beige Book in the United States was relatively upbeat, and we had the number 2 official at the Fed, Janet Yellen, making some comments that further monetary easing could be warranted if the U.S. recovery proceeds at a slower than expected pace. So I think that in the United States we've seen a good start to the year. Market expects and the Fed expects growth in the United States to be 2.5% to 3%. We're overdue for a correction in the U.S. stock market. I think we're seeing that right now. I think it's going to be a rocky road here until the second half of the year. Once we get past the likely volatility ensuing from the Greek general election, I think what you're going to see is upbeat equity markets and a positive U.S. economy.
Okay, Michael, good speaking with you. Appreciate you taking the time out and joining us this morning on ET Now.